Thank you very much. I'm Carolyn Wu. I'm the Dean of the Mendoza College of Business. It's really a great pleasure, privilege to welcome you to this first learning event that we are hosting for alumni and our friends of Notre Dame as a learning event. And I just want to say, first of all, this event would not have been possible without the support of two of our Business Advisory Council members and Notre Dame alumni. We have Roxanne Martino and her husband, Rocco. Could you please stand so that people could really do the due diligence? And we also have Gary Garibrand, who is the CEO of Equity International and who also underwrote this event. Please stand. And just to brag, Roxanne runs the Aurora Funds, and her hedge fund was selected as the hedge fund of the year for 2010, I believe. So anyway, we have distinguished people. Our first topic that we chose is on emerging market, just because whether we know it or not, particularly through our retirement portfolio, everybody's investment portfolio, there's a lot, or a little bit of emerging market investments in a lot of places that we're not even aware of that relates to us. But overall, there's just not a lot of really deep, familiar knowledge associated with emerging markets. So we thought that the first learning event would be around emerging markets to get our people to have a deeper understanding of the opportunities, of the challenges, of the trends associated with emerging markets. And we said, who should we turn to as the expert? And we turned to Nenad Pacek, our speaker, whom right now I couldn't see because Nenad is supposed to be here. All right, but he's coming. So while I'm introducing him, I actually served with Nenad on the board of the Center for Creative Leadership. I was always so impressed by the breadth and the depth of his knowledge. He always reminds us Americans of sort of a different view coming from sort of not only Europe, but from his client base, which is spread all over the world. He has advised over 100 companies in this area, and I'm not going to introduce him because that's Bill Wigenhorn's job. But I just want to say I was so impressed with Nenad's insight and his experiences. I said we need to bring Nenad to this particular group. So I will turn over to Nenad, but before then, I'm also going to bring Bill Wigenhorn up, who is actually going to do the introduction. A little bit on Bill Wigenhorn. Bill and I have been friends for over 20 years. We first met when I was at Purdue University, where the president's office said, Carolyn, we need to submit a proposal to Motorola, because Motorola in the days of TQM was the leader, total quality management. And Motorola said, the university that has a winning proposal, Motorola will spend its money to educate 100 of its top leaders, from presidents, vice presidents, provosts, the academics, and also the administrators. 100 people will be trained for 1 week at the Motorola's expense. So I was a young kid. I didn't know what I was doing, but I was asked to write this proposal. I wrote this proposal, and for some reason, we won the proposal. So from then on, my life and Bill Wigenhorn's life was intertwined. Particularly, the winning organization has to demonstrate how we then put it into practice. So that was like a couple of years of trying to change culture within an organization. Bill at that time was the CEO of Motorola University. It was the most creative organization of its kind. It actually facilitated the development of the China market, not only for wireless, but opening the China market actually for a lot of industrial activities and helping build the infrastructure of China, particularly in human resource, for this whole opening and trade. So Bill taught us a lot. And another thing you need to know is about 10 years ago, we always get together, and he said, is there anything I can do for you? I said, yes, I need a crackerjack director of executive development, executive education. And he said, I will introduce you to Leo Burke. So those of you who know Leo Burke will know what a debt I owe to Bill Wigenhorn. And Leo at that time was working for Bill. So today, Bill Wagenhorn has his own company with his wife, Pat, who's also here. They do executive education, development, human resource consulting across the world. Bill actually does not live in Chicago. He lives on a plane. He's worked in 63 different countries, and he is also the one who brought Nenad and me together. So anyway, Bill, would you do the introduction of Nenad?
Thank you very much. Well, I better change my introduction for Nenad because I need to make it longer since mine was so long, I guess. First of all, Carolyn's done really well because she was our first instructor at Motorola University. And she taught the first strategy course, and we probably should have listened to her. Things have been much healthier today. But we had a lot of fun working together. And I think one of the things I've learned from Carolyn is to, one, make sure you have your values and know where you stand. And we've been in China since '81, and I used to say, the thing that was very interesting, the two most popular lectures was one entitled One Eye Open, One Eye Closed, and the other one was Why Gray is a Beautiful Color. So if you start with that as your foundation, you have to move forward, and you have to have, I think, a real foundation in your own values and ethics. And over the last 10 years, one of the things we've been concentrating on is finding the person who's going to write the next book. So we spend our time looking for the new generation of the thought leaders. Because my theory is, once you've written a book, we can buy it for $30, read it, and move on. We don't need to pay $30,000 for you to read the book to us. So in our search for someone that really understood emerging markets, from an opportunity point of view, a risk point of view, and a structural point of view, we located Nenad Pacek, who was living in Vienna at that time, is still there, but he was with the economists at that time and headed up their research group. And two things struck us. One is that he made the point of here are the opportunity and risk, but number two, and this has been very hard for our clients to get through their heads, is that you have to organize differently for those markets. So you have to think differently. You might need different types of people, you need different type of reward systems, but you can't take a European or US model and put it into these markets. I spent the last 2 days with one of the largest pharmaceutical companies that actually read his book and is doing this. So he split the company in developed markets and emerging markets. Each one has a CEO, totally different type of product portfolios, etc. So hopefully as we explore this morning with Nenad, get a feel of not only his view from an economic point of view and all the turmoil that's going on. His group publishes papers. They used to come out like once every 6 weeks. Well, with everything going on now, it's about every 4 hours. You get kind of an update. So hopefully he'll be able to give us that update this morning. But I think number two is how do you organize yourself to really go into that marketplace? 20 years ago, he started his career when he moved to Vienna from Croatia. And today has a consortium of over 200 companies who subscribe to his research. And he holds these meetings around the world. And Ann Fiera, who you'll meet later, just attended one in Moscow where 90 of the executives show up and have very candid discussions. And so to me, the value is getting the information right from people dealing with the issues. So with that, I'd like to introduce Nenad, and where is he? Oh, okay, thank you.
That's good.
You're okay.
Good morning. It's a great honor and privilege to be with you this morning and later today as well. I expect another group in the afternoon as well. Chris Rock, the U.S. comedian, said a few years ago something interesting. He said, you know the world is crazy when the best rap music is made by a white guy, the best golfer is a black guy, and Switzerland holds the America's Cup in sailing. And that was before a very lovely young Swedish woman beat up a young man called Tiger with a golf club. So now it's a German who is the number one in the world. But I can add a few things to this. You know that we live in a crazy world when after this meeting you and I can walk into a bank and ask our broker or whoever he is and say, can you buy me some South African rand and the Turkish lira because it's a high interest rate. And if, please, by the way, sell some of the currencies that I've been holding for the last 48 hours, and I don't like them anymore. The other thing, you know, that we live in a crazy world, is that, again, after this meeting, you and I can go and buy some copper and oil, although none of us would probably need a barrel of oil to put in our garage. And you also know we live in a crazy world when we, in the last 35 years, had more economic crises than in the 350 years before that, as Charlie Kindleberger said in his great book. And still, we trade things that most people don't understand. Certainly governments don't. And I think the risks still for the global economy are out there. And also another interesting quote about how we ended up in a crisis and where we are going, also from a U.S. cartoonist, Bill Watterson, who said the following. He said, the surest sign that intelligent life exists elsewhere in the universe is that none of it has ever tried to contact us. And Albert Einstein was good on stupidity as well, and he said there are two things that are infinite. First, the universe, and second, human stupidity. And then he went on to say, but I'm not sure about the first. And if you think about this crisis, and I've been thinking about it a lot, and we all somehow survived it, and it was the biggest one in 80 years, you realize that this is being recorded, so I'll be very nice. I'm not going to say everything I think, really, but if you want to hear some of my real views, you can invite me in privately to speak into your company, whatever. We can have lunch. And I think we're living in the post-robbery world, and I think we have just seen the largest bank robbery ever pulled off on the planet Earth, and we will feel the consequences of this for a very, very long time. And actually just confirms the old saying that the easiest way to rob a bank is to own one. And I think we have seen this throughout the world as well. And it has huge implications on how the world will look like in the next few years. We will also see over the next few years how things are changing on the economic front and on the business front. And basically my presentation today is about those two things. First of all, I'll give you a very big picture on what are some of the big economic and business trends. And I'll give you a quick tour of the world, how different emerging regions are looking at the moment, how they are going to behave in the next few years. If you're looking at your business, your strategies, where things are going to move, I'll sort of try and highlight which markets will be winners, which markets will be losers, and why. And then in the second part, it will be a tour of best practices of what companies are trying to do now to be successful in the future, and how some of the things are changing within organizations to try and reach sustainable growth in emerging market economies, because this is where the growth is going to be. I think there is a very clear corporate consensus that it's very difficult to find sales growth in America, also in Western Europe, but also in Japan, and of course emerging regions will be those where companies will be able to find a lot of growth going forward. So I'll walk you through a few things related to some of the global megatrends. And let me walk you slowly through all of these. Some of these will look familiar, but I will add maybe another dimension to some of those as we go through it and as we explain the countries and markets. The first of all, I think we all know moderate economic growth is something that is going to be around us for some time. Whether this is another 5 years or whether this is a 10-year horizon, it's probably along those lines. And I think we will see rounds of volatility, whether these are linked to high commodity prices, speculation, the impact of quantitative easing, which is still going on in many markets around the world, and its increasing liquidity and inflation rates in emerging economies. Those things will be with us for quite some time. I think this term new normal is around as well, although I somewhat disagree with this because I think everything we had before the crisis was the old abnormal. Because it was, I think we're actually now in a more of a normal. Because everything between probably 2003 and 2007 was, of course, the largest credit bubble we had in many decades. And it will be difficult to repeat it because I suppose it will be a long time until people again start to buy some of the AAA rated securities. My grandfather died recently when he was 106, and I'm 43 now. I hope I'm going to live that long, or maybe a little longer. But it will probably be my grandchildren who will receive a phone call from somebody saying, would you like to buy my AAA-rated securities? And because I will still be alive by then, in 80 years' time, I'll be able to advise my grandson or granddaughter, don't buy that, because it happened again. And probably those things will circulate around the world. I will explain what are some of the reasons for all of this in number one. I just wanted to give you an overview. The other point, number two, the rise of emerging markets, relative decline of the developed world. For this, let me take you quickly to the year 5000, just quickly. And it's the University of Beijing. The professor is writing a book about economic history. It's probably one of your grandchildren, Caroline. And he asked one of his graduate students to go back 4,000 years and look for some data so that he can make some conclusions about economic history in the last 4,000 years or so. And then the student runs back to the professor and says, Mr. Professor, look, I don't know if you knew this, but between 1850 and 2010, these entities called United States of America, which we finally conquered 1,000 years ago, and Western Europe and Japan were actually bigger than emerging markets, never before 1850 and never after 2010. And we have actually just hit that point now when at purchasing power parity, all emerging markets are roughly the same size as the developed world. I'm just trying to illustrate the point with a little sort of story from the future, but you get the point, and I will elaborate this again in a few minutes. Point number three is interesting. I think we see among my multinational clients, we have now contracts with over 200 of them, some of the biggest names in the world. I think the real corporate consensus is that growth in the next, let's say, 3, 5, 10 years will be coming from emerging markets, sales growth and profit growth as well. And profit growth, by the way, tends to exceed the sales growth in many of the emerging markets for many companies. But it is really a tremendous corporate consensus that we have these days. And you will see what companies are trying to do about this. It's not easy to take advantage of all of those opportunities out there. Point number four, and I will elaborate this again in detail, is that we are now entering an extreme competition around the world. And I will tell you the reasons why. But it's getting very severe. And it really is calling on companies to change the view of emerging markets, how you run the business, what is your structure, what about your supply chain, research and development, sales strategies, marketing, everything you do, manufacturing, etc. Again, we'll go through this. And point number five is maybe one of the biggest responses that companies must have as a response to slowing or slower economic growth around the world and huge competition that is coming up. Now let's look at number one in a bit more detail. And throughout this, I will also give you a quick tour of some of the developed markets in terms of economic performance and some of the funny things that are happening again, and perhaps some misconceptions. I see a lot of analysts working for big banks quite bullish about some of the developed markets, particularly growth forecasts for the United States, which, if you take the consensus view, it seems now in the next few years, the United States is going to grow faster than it did in 2006 and 2007. And I just don't think that makes a lot of sense, and I'll tell you why. First of all, in the developed world, as you know, we have extremely substantial debts. Particularly, this is the case in Japan, in Western Europe, but to some extent also, of course, in the United States on the public debt side, but also if you look at the household debt, small and medium-sized companies' debt, etc., it is also extremely substantial. Let me just walk you through this and then highlight what is happening in some of the developed regions and the markets. First of all, in the next few years, many governments in those developed markets will be increasing tax, or different taxes, and they will be cutting spending on a number of things. We are still seeing in all of these very stubborn unemployment and jobless recoveries largely. We all know how still difficult it is for young graduates to find work in the United States, the same it is in Europe, etc. Credit growth, is really not going back to those days that we had before the crisis. And I don't think we're going to see a repeat of that credit bubble anytime soon, as those memories will still be around, and nobody in their right mind will be buying the so-called AAA rated securities from anybody. So it will be hard for some of the financial institutions to do the things they were doing before in terms of hiding and selling liabilities to others and pretending these were the great investments. We will see a lot of volatility, of course, and many false dawns. Suddenly you get a good result in a country and everybody will get enthusiastic. The next month or the next quarter, things will go down. And then again, the sentiment in the marketplace will change and move around. What will happen after quantitative easing is over is US and Japan and some of the other markets in Western Europe, are they really standing on their own? Is confidence and trust back, which we destroyed in the crisis? By the way, this whole crisis, in my opinion, has been a combination of crime, fraud, corruption, bad regulations, greed, and stupidity, where we managed to destroy the two basic pillars of capitalism, confidence and trust. So it's very difficult to move that quickly to the sort of normal levels. The other thing that we have to observe, and particularly if you're looking at emerging markets, it's the issue of hot money going in and out, and you have seen how much of that has gone into Brazil, some of the Asian economies, how it's chasing yields in South Africa and Turkey and in other locations, and then suddenly it moves and leaves those economies exposed. So when I go through some of the emerging economies a little bit later, I'll highlight which markets might be a little bit more exposed, so when you're doing your planning, strategic planning for some of those markets, that you know which markets are a little riskier than others. And in many of the developed markets, we see balance sheets restoration and, of course, a psychological impact of the crisis on any future behavior. As we know, many recessions are really psychological, especially in the aftermath of many of those. But the bigger point, of course, is that we're also going to have slower growth in emerging markets in the next 2 years. And we had a very nice bounce back in 2010, almost universally across the emerging market world, except for some markets in Central and Eastern Europe. But they have to slow down because it was coming from a low base, and they are also tightening their monetary policies, fiscal policies. So growth will not be as strong as it was in Brazil last year. It will be a little slower in 2011 and 12. And this is what you also have to keep in mind. Because one of the things that's happening for many companies operating in around the world is that the CEO of a company calls the regional guys and says, you had 22% growth in Asia last year, I want 27 this year. And actually, he's asking that at a time when economic growth in Asia will slow down a little bit. It will be the same in Latin America. It will be the same in Middle East and Africa, especially now after the turmoil in the Middle East. And so managing expectations of the boards, of the CEOs, is one of the biggest things that companies are now trying to do, and inform and educate senior management about what's really happening out there. But let me also just give you a very quick tour of some of the developed markets. Let's start with Western Europe, if you're doing any business there, and it really has a huge impact on the emerging world. If you look at West European markets, there are only, in the Eurozone, there are only two large strategic markets that basically do not have public debt that's too high. And that's Luxembourg and Finland. All the others have high debts, including Germany, France, and of course Italy, Belgium, Spain, all the so-called pigs, etc. The average for the Eurozone at the moment on the public debt side, we ended 2010 with an astonishing number of 88% of GDP. As you know, anything, sort of an international benchmark, anything higher than 60% is usually considered to be bad and you need to reduce it. So in Western Europe, we are almost at 90, and in the next 18 months, it's going to hit 100%. Which means that all of those will be doing this exactly: higher tax, lower spending, and we're already seeing this. There is very little corporate sales growth in Western Europe at the moment. It is really a difficult struggle. I would only say any sort of B2B companies, they're doing reasonably well in places like Germany, because Germans are exporting a lot to emerging markets, and you see bits and pieces of that demand for B2B products in Scandinavia, Austria, Netherlands a little bit. But the rest is quite weak. For all the other industries, it's very difficult. Pharma companies are struggling, reimbursement prices are going down, consumers are not spending, etc. Then you go to Japan, which is today on the public debt side. There are only two countries that are worse than Japan, and that's Zimbabwe and St. Kitts and Nevis. And it's at 240% of GDP. With the aging structure of the population, eventually they will have to do all those things, higher taxation and even significantly lower spending, which means that also the business outlook for sales growth, corporate growth in Japan is probably a misery for the next few years. And it has been, by the way, for quite a few years for most multinational companies. And of course, in the US, public debt depends on how you counted it officially. We are going to about almost 70% by the end of 2011 and gently rising. And of course, with all the other balance sheet restorations in the US, I hear from my clients that also sales growth in the US is a challenge these days in a number of industries. And so this is something that we need to keep in mind. Why does this all matter? Why am I speaking a few minutes about the developed world? United States, it's almost 30% of global GDP at market exchange rates. Western Europe is almost another 30, and Japan is about 9. So we are looking at about 69% of the world at market exchange rates doing quite badly in the next few years because of all these reasons here. And this is why many eyes, corporations, executives who are looking at the whole world, they are increasingly looking at the emerging markets and saying this is the place, the only one, where we can find some growth because we still cannot go to other planets to do business. Now, looking at the other big trend, and just to highlight some interesting data here. We live in an interesting world. As you see, in the developed world, high debts, very low reserves. Emerging markets, low debts, very high reserves. We didn't have that in our lifetimes. And really, this crisis has just made it more visible. It was already going in this direction, but it's just become extremely visible. And you can see already, if you aggregate all those emerging growth markets around the world, 75% of all global foreign exchange reserves are held by those markets. And then we're looking at already, they're buying half of the world's oil, half of the world's exports. And the macroeconomic fundamentals are really solid in many of the markets. There are only pockets in Central and Eastern Europe where fundamentals are weak. And I'll talk about some of those markets in a few minutes. And look at all the others, it's looking very, very solid. Look at the population, the last bullet point, over 80% of the world's population already, rising 6 million people every month. And all of that 300,000 growth in the developed world, it's actually mostly in the United States. And it's actually mostly through immigration. And of course, companies are paying attention to this because this is where some of the growth will be coming from in the next few years. When you look at that outlook in terms of economic growth for some of the emerging regions, you are seeing in the next few years, like before, that they will outperform the developed world by a margin of about 4 to 1, approximately. And this will spill over into higher business demand as well. And I spoke about the corporate consensus view as well, and there is very clear allocation of resources going in that direction. I have some clients who are now actually allocating 80 to 90% of all of their business development, new business development investment to emerging markets, which might be a little bit too much because you still have to take care of the large volume, slow growth markets as well. And I'll speak about that later on. But the other important point in all of this is that companies, and I will demonstrate this a little bit later with a few more slides, they are becoming much more systematic about their operations, the way they do business in the emerging world, and the allocation of resources and new funds that are going to be on the ground to make this happen. Point number 4 on those megatrends, just to elaborate a little bit along those lines, is multinationals are getting significantly more interested in emerging markets, as I said, and they are putting more and more resources on the ground. On the other side, there is another competitive threat which is accelerating at an unbelievable speed. And these are the so-called local companies, domestic companies in Brazil, Turkey, China, India, Poland, Russia. They are going regional, they're going global, and from some of those markets they actually have a lot of money to go abroad. And they're not easy to compete against. And we shouldn't underestimate anybody. And we will talk a little bit more about this later. But it is a huge threat for many companies, and it's already day-to-day headache for many firms as well, as they have to compete with a Chinese company that comes into, Turkish market, and they sell exactly the same earth-moving equipment as Caterpillar for 30% discount. And same, almost good quality as Caterpillar would make. It's a huge headache. What do you do? So I think the international business arena will get more complicated than it has ever been in the next few years. And this is why I think the title of this whole presentation is about these emerging strategies and what you need to do to play well in that space, where economic growth is not great. Even in emerging regions, it's not that fast anymore. It's good, but it's not booming. And with all the competition. So what do you do? And we'll speak about this in a moment. But many of those competitors are closing technology gaps. They're closing capital and talent gap. And at the same time, they're not easy to compete against. Just look at the last bullet point. These are some of the things that companies are complaining about these days. They have different margin objectives. They pay bribes to win business very often. Not always, but it's very hard to compete against that with all the things that you have to comply with. And often have low prices, very acceptable quality, which is going up and all the time. And they are poaching best staff. They go to some of my multinational clients and say, you're working for 3M in Moscow or in Istanbul, and you're making $200,000 a year. We'll pay you $500,000 to come and work for us and bring all the knowledge to us. And it's happening all the time. Some of these local companies are cash rich, and they buy the best talent at extreme high prices. And at the same time, they're copycatting products and campaigns. And of course, there's a lot of government cash supporting some of those expansions, some of those companies. And we also see some taking of the IP as well, intellectual property in some places. But that's to be expected. It's nothing unusual, really. I'll speak more about this later on, but just to highlight a few important points related to this innovation story. And this really sounds like a cliche, but it's actually moving to a completely different level these days. And what companies are trying to do now is they are realizing that even in some of the emerging markets, the customer is different, the consumer is different. Coca-Cola, for example, they tell me the consumer, we still don't understand them well. Coca-Cola, would you believe that? I say, we don't understand the consumer well enough. Procter & Gamble say they think after the crisis, the consumer must have probably have changed forever around the world. We need to adapt to that as well. SAP, the German IT company, one of the top executives told me recently, before the crisis, we were sitting near the phone, aggressively taking orders. It was that easy to do business. And after the crisis, now all these customers are demanding. They're asking questions about our products and what we are selling. And we need to re-educate our sales staff. Everything is very different along those lines. But the bigger point is the big exercise which is taking place in many multinational companies these days. And say, this is our product portfolio, or the services portfolio which we have. On the other side, let's really understand the market needs in those places like China, India, Brazil, and how they are evolving and changing and so on. And then we have to say, do we have a match with what we make and do with what the actual market needs are? When companies do this scientific exercise, and it's becoming quite scientific, you realize that mostly the match is at the premium end of the product cycle, or the premium products, and that anything below in the middle of the pyramid, or God forbid, the lower levels of the pyramid, there is very little that companies are offering to come to those consumers and customers in emerging markets. And the other thing, I call this multiple segment innovation. You know, it's called downward innovation, with innovating upwards as well. But I think ultimately the play in the next 5 to 10 years will be that many companies will try and go head on into many of the segments that are out there, because this is where the growth is going to be. Many companies expect that growth will actually be in the middle of the pyramid, not necessarily the top, because this is quite mature. Even in some of the emerging markets, it's a busy space. But what's not busy is the medium segment, and second tier, third, fourth, somewhere in the middle. This is where a lot of growth will come from for companies. And this is why many of them are now doing new R&D. They're opening R&D sites in other areas of the world. They are producing new products and services, creating them, etc., to try and meet those market needs and find growth, because ultimately this is all about growth at the end of the day. And an interesting point, maybe 3 or 4 years ago, when I was still with The Economist, I interviewed a young woman from Singapore for a position. And at the time, I was managing our business in Europe, Middle East, and Africa. And we had some business unit that I was running globally as well for Latin America and Asia. And I was looking for somebody who can do business or feel comfortable going into some of these emerging economies. And she was great and wonderful CV, and I really liked her a lot. And then she said, I asked her, you don't have much experience in emerging markets. I like you a lot. Everything is good. But I would really like you to feel comfortable going into some of these places. And I said, have you at least traveled privately to some of those emerging economies? And she was probably about 24 at the time, or 25. And she stopped. Her face turned extremely serious. And she said, I was once in Naples, Italy, and I was once in Detroit. And she was completely serious. And of course, a few of my colleagues who were sort of doing the final interview. The reason why I say this, because there are parts of the developed world that also look very like emerging markets these days. And what's happening when companies do this and they develop a product for the second and third tier, they can also sell it at home. And it's not only a strategy for emerging markets. It's a global strategy, if you want. The second-tier product will sell well in the parts of the United States. It will surely sell well in Spain and Italy and some of the other places. And I think this is the way to sell it to global boards. This is a big struggle, by the way, in many companies. Why should we go to the second tier and third tier? Because it's going to cannibalize our premium stuff, and it's going to destroy our business. We shouldn't be going in this direction. But then competition forces you to go in this way. And the way companies are trying to convince their CEOs and boards is all the regional heads who are running Asia, Latin America, Eastern Europe, Middle East. They come together and they make a pitch to the board and say, we need all these products in the second or third tier and so on. But then, of course, the biggest point of impact is you take the CEO and top corporate officers to visit some of these markets, to talk to the customers. And more importantly, you tell them, you will be able to sell this in parts of the US and in many of the European markets and in Japan, etc. This is not only for emerging markets. It's part of our global strategy going forward. But again, I will expand on some of these points in a few minutes. Now, let me give you a quick tour of some of these emerging regions as well, and highlight a few points related to this. First of all, I think emerging Asia will be outperforming just about any region of the world going forward. And you might be wondering, well, we've seen this before. Remember, 1990s, everything was great, Asian tigers, nothing can go wrong. In 1997, of course, everything crashed, except China, largely. And, of course, it will happen again, won't it? Things are somewhat different. Although risks are still, some risks are there. I'll try and qualify them. But things are fundamentally different. Today, unlike in 1997, emerging Asian economies hold almost $5 trillion of foreign exchange reserves. The money which they didn't have in those days. In about 2000, they had approximately, for the whole area, about 500 billion. So it's a tenfold increase in reserves, which they have accumulated, because what they didn't want to do after the crisis ever again is to go to Washington and beg money from the IMF. Come and rescue us and things like that. They wanted to have a buffer so they can be the masters of their own destiny. The other thing which they did in the aftermath of the crisis, and this is good news for business and your strategies going forward, is that they cut foreign debt. In many markets around the world, foreign debts, as you know, are very high. In Asia, it's 17% of GDP, 17. We know countries collapse and need the help of the IMF historically, based on wonderful research from Ken Rogoff in his book, 69% of GDP. Once you hit 69, countries usually default or start getting into trouble, cannot service their obligations. Asia is at 17, aggregate. Public debt, I told you the numbers for the developed world, 33% on aggregate for emerging Asia. The only country where you have a public debt, sort of a mini problem, is India, where it's about 72, 73%. But it's still lower than Western Europe and roughly the same as the United States. You have to really look hard around Asia to find real problems with the macroeconomic fundamentals. In most countries, it's actually current account surplus, which means that currencies will appreciate inevitably over time, except Vietnam, which is running a fairly sizable current account deficit, and it's a real issue, and it has twin deficits as well with the budget deficit. And then, of course, you find somewhat lower savings in Korea, etc. But on aggregate, you look at all of these markets and everything else, it looks very, very solid. And at the moment, for multinational companies, Asia is the fastest growing area of the world in terms of sales growth and profit growth. And the second one is Latin America. Latin America has changed, and you can be very cynical. We can all be about this part of the world, because we all remember the debt crisis, and it was not so long ago, 94 Mexico, then Brazil came in 99, then we had Argentina and Uruguay collapsing and going nowhere. In the meantime, the last 10 years, you look at the aggregate figures of some of the major Latin American economies, and today, most of them would be able to join the euro because they meet the criteria. Unlike most of the West European economies, I think only actually, as I said, Luxembourg and Finland would be able to qualify and join the euro if they would need to qualify for it tomorrow morning. So Latin America is now holding about $650 billion of foreign exchange reserves. And on aggregate, its foreign debt, as for the whole region, it's around 20%. And on the public debt side, we're about 45, half of Western European levels, for example, and below that international benchmark of 60. So both in emerging Asia and in Latin America, you don't have a need to deleverage. You don't have a need to increase taxation. There is no need to cut spending. And it's all about growth in many of those economies. As I said, they will be slowing down, and Asia will not be growing as fast as it did in 2010, and Latin America will grow probably around 4.5% to 5% in 2011, from about 6.5% in 2010. But still, these are acceptable and very nice growth rates. Then we come to a more complicated area of Central and Eastern Europe. CEE stands for Central and Eastern Europe, which includes Russia, Turkey. Most companies include Turkey, by the way, in their operations in CEE. And that part of the world, before the crisis, borrowed too much. Governments, households, companies, everybody borrowed like crazy, and now they have to deleverage many of the markets. Those markets that will do better for the business in the next few years are those that do not have that problem, and that's Russia, which has some of the best economic fundamentals in the world. It has virtually no public debt. It's sitting on $600 billion of foreign exchange reserves, which is the third largest accumulation in the world. And its public debt is also very low, and business is coming back quite nicely in Russia these days. This is at least what our clients are telling us. Turkey is a booming market as well. Turkey is a little bit like Brazil for me. It has grown out of its debt problem, and in the old days, it was simply doing things to pay back the old debts. Now this is largely gone. And Turkey is also one of the highest priority markets, I think, in the emerging world these days, based on these fundamentals, but also on a very solid government, which has been running the place for about 8 years now. The other markets in Eastern Europe, which are not too bad, Poland, Czech Republic, Kazakhstan, Azerbaijan, although some of these further east are very dependent on commodity prices, and that's something that you should keep in mind. With commodities these days, you never know, and I'll say a few words about this as well. Middle East and North Africa. Until a few weeks ago, my remarks would be somewhat different than they are today, as you can imagine. But we still have to keep in mind some of the basic things here. Middle East and North Africa is now holding the second largest accumulation of cash and liquidity in the world. And it's a total amount estimated at about $2.6 trillion in reserves and in sovereign wealth funds, which are, of course, investing around the world still today. The money that some of the markets have is quite significant. Abu Dhabi is sitting on about 650 billion. Saudi Arabia, minimum 450 billion. Qatar is almost at 100. Kuwait is 250 billion, etc., etc. And some of the Gulf markets, in my opinion, will be able to go through this crisis without going into the Libya or even Egypt type of scenario, because they'll be able to pay off their population. As you may have heard already, the Kuwaiti government is now distributing free food to their population as well, so they are not marching on the streets. And in other markets, of course, there are heavyweight subsidies on everything to try to calm things down. If you're worried about Bahrain, I don't think anybody will allow Bahrain to go into the Shiite hands, because it will mean higher influence of Iran. And also at the same time, the biggest fear, of course, is you don't want Bahrain to get out of control, because it's in the eastern Saudi Arabia, where the Shiites are also majority, and these are some of the largest oil fields in the world. If you would have the turmoil on that side of the border, then the oil price will be probably $250 a barrel already in a few weeks' time. And so nobody is going to allow this. And of course, the U.S. Fifth Fleet is also in Bahrain. And it's hard to imagine that anything beyond certain, let's say, cosmetic political concessions will be made to those protesters in Bahrain. I think in places like Egypt and Tunisia, I think we're going to go through some form of, let's say, managed elections. And there will be either a scenario of Turkey, where you have a secular type of government in those places, coexisting with the military establishment, which basically has been running those places forever. And they will still have a huge influence, whatever happens after the elections. And my view on those markets is they will eventually calm down. With Libya, I think probably Gaddafi is out in a foreseeable future, in whatever that means. Maybe a few days, maybe a few weeks, maybe a few months. But it's very difficult to imagine that he will be still around after all of this. So it's a very mixed picture over there, and business has actually not been great the last few weeks in the Middle East, as you can imagine. The Gulf is still going okay for companies. We still see reasonably good businesses, places like Algeria, Morocco, without major disruptions, but big disruptions in Egypt, of course, Libya and Tunisia, and needless to say, Yemen, which very few companies care about anyway. So I think when all of this sort of calms down, I think what's important to think about is that Middle East and North Africa is sitting on an incredible amount of cash, and it's going to invest hundreds of billions into various projects. Multinationals are lining up in Dubai in their regional headquarters. They're beefing up their local presence, and they're going after those big investment plans. In Saudi, 450 billion of investments in the next 5 years. In Kuwait, hundreds of billions, 104 billion approximately, etc., etc. These are very large things that will happen there for business, and everybody wants a piece of the pie. In sub-Saharan Africa, I won't spend too much time on this because it actually accounts for about 1% of global GDP, or 1% of typical sales of multinational companies if you take it as a percentage of global sales. So it's not a huge priority, although we have seen a huge inflow of multinational companies going into sub-Saharan Africa. There are two good things about sub-Saharan Africa. It's not so competitive like some of the other places in terms of competition and other businesses. Of course, it's the Asian companies from China in particular who are going in and taking a big chunk of the business from Africa. But at the same time, I think this trend of what do we do with Africa is also on the agenda of many companies. And what is our strategy for that part of the world? It's one of the most complicated things in international business. How do you prioritize 44 bad markets, if you want? And where are we going first? And what's the best way? Should we just focus on South Africa, Nigeria, and Kenya and leave it at that? Or we also want to have a distributor in Burkina Faso? But these are the things that companies are now really scratching their head about, and we will see what the outcome might be. There's a point here on commodity prices, which I will just touch on a little bit, because some of these emerging areas are very dependent on commodity prices. Good chunk of Latin America is, so that's a risk to the scenario. Middle East, of course, is. Russia, Kazakhstan, places of that kind. And then, of course, Chile and a few other places that dependent on one or two commodities only. The same you can say for the sub-Saharan markets. I think we've seen, I was presenting, and Bill knows this story, some time ago to a group of commodity traders in Switzerland. And during the break, one of the largest commodity players in the world, the executive director, came to me in the break, and he was actually physically shaking a little bit like this all the time as he was talking. He was close to retirement, and he said, "I loved your speech, and let me tell you a little story. I've been in this business for almost 40 years. And in the first 37 years of my career in commodity trading, we roughly knew what we were doing. And we were trading, we knew what the demand would be roughly, we were trying to estimate this, and then we also knew roughly what the supply of certain commodities will be, and we didn't see that much volatility." And then he said, over the last few years, everything changed. You had in the morning a player in the financial industry taking a bet on cotton prices in the morning. They would walk into Lehman Brothers and say, "I need a loan of $10 billion to place a bet." And Lehman, of course, wouldn't care because it wasn't their money. And they would just went to the wholesale market and say, "Here, if you want to play the bet, here it is." And you had huge amount of leverage speculation, which he said was just causing enormous difficulties for the industry. And when all this crisis happened, I think oil is a prime example with all of this. And it's as crazy as you can imagine. It was not so long ago, about 13 years ago, when the oil price was $9.64. Many of you will remember this. Then for many years it was trading around 20. And then as the credit bubble around the world went crazy and all of that leverage speculation started to kick in, but of course there was extra growth in many of the markets around the world, so there was a sense everybody needs all these commodities, so there was a combination of the two things. But still, then oil price zoomed to 147. Then you look at the real oil consumption around the world during that time, and you find that every year the annual increase in oil consumption between 98 and 2008 from 964 to 147 was 1.7%. Never more than that on an annual basis, on average. And then, in a panic sell-off, it went to under 40. And then Merrill Lynch, I think, came out and said it's going back to 20 again, or 25. And then it bounced back. But by the way, during the time of 147 to under 40, it actually, the decline globally in oil consumption was -3. Then from 35, 40, going to where we were a few weeks ago before the Middle Eastern crisis of 90, 95, 100, globally, annual consumption going up 1.3, 1.4%. And in developed markets, it's actually falling. And not much to do with the fundamentals. And you see this also in many other commodities today. The Barclays Capital now estimate that if you aggregate the speculative amount of capital sitting in some of the commodity markets, and only in oil, they estimate more than 100 billion. Before the crisis, it was probably about $500 billion altogether, just in oil, because a lot of that speculation was leveraged as well. And of course now we have an added complexity of the Middle Eastern crisis, which has zoomed up. All the commodities have gone up in price. But the reason why I'm saying all of this is if you have this wonderful plan to grow and business in some of these commodity-dependent economies, and there are many of them in the emerging world, you have to take that into account. Because it is insane, it often doesn't make any sense, and you can present this wonderful plan to your CEO and the board and say, we are going to grow 37% in the Middle East and whatever in Latin America, and then the commodity price again goes into a panic sell-off, and oil price goes to 40 or something along those lines, then in that case you have a problem not only for your business, but your career as well, as it often happens in companies. And I do spend a lot of time with oil majors as well. And they said, one of the meetings in Dubai, which I hold with my clients every 3 months over there, one of the big oil companies operating in the world, they say, internally, we think oil price is between 40 and 55. And we never use a higher number than this. And we think everything above that is pure speculation. Because the fundamentals of the supply and demand are roughly along those lines. You see this, by the way, in all the Gulf governments as well. They say, if you look at the budget of the UAE or Abu Dhabi or Saudi Arabia, they also say, you can see this now, for 2011, most budgets are set at 58, 59 maximum. So they're keeping it at that upper range. And interesting insight from some of these oil majors when they say they think for every real touchable commodity, there is at least 4 to 5 futures contracts traded. And this is why this extra volatility. And it comes, as you can imagine, from all this printing of money, which we popularly these days called quantitative easing, not to scare people. But it is ultimately a huge amount of money printing, particularly in the United States, particularly in the US, and less so in Western Europe. So, and hot money is another thing you have to keep in mind as a risk in emerging markets. All of this extra liquidity as a result of all the money printing that we see is ending up in treasury bills of some of the emerging economies, in currencies, in government bonds, whatever they might be, different pieces of papers and securities and so forth. And all of that money can also leave. And although, as I said, the situation is different than it was in the 1990s, because if the money suddenly leaves, Asian economies have the reserves to defend their currencies these days if they want to. Although probably they will even be happy for the currencies to fall so they can keep their exports cheap, as they have been trying to do for many, many years now. So, but still, that's a risk that you have to keep in mind, and there are certain economies around the world that are more exposed to this hot money inflow and outflow as well. Now, let me go to some of the more business issues in the remaining half an hour or so. You probably know this, but if you look at the Fortune 500 list 25 years ago, you see 60% of those companies are no longer on the list. And I talk a lot to executives who are running global business and regional businesses. And I think there is also a nice consensus view out there that most of the corporate collapses or declines on these rankings are largely due to corporate short-termism, particularly for publicly listed companies that are under pressure from Wall Street analysts and other analysts around the world to deliver what they promise quarter by quarter. So many companies turned into what I would call managing of the bottom line rather than the business. And when you run a business like this, then of course it's never good for long-term sustainability, and it's never good, and it's catastrophic for emerging market business at the same time. So a few other interesting things. For an average multinational company today, a share of emerging markets profit exceeds share of emerging markets revenues, which means there is a lot of good pricing power in many of the markets in the emerging world. Consumer and customers are still willing to pay good money for the quality, and the margins in some places like Russia and Brazil are particularly high in a number of industries. And it's interesting to see this in many, many locations, although it's getting tougher, of course, as everybody is moving in those locations. So this is not going to be a permanent feature of any kind. Interestingly enough, on aggregate, if you look at European and Japanese companies, they're holding larger market shares in all emerging economies around the world, largely because they're not under so much stock exchange pressure. And they're able to take a somewhat longer-term view, channel resources on the ground, develop the business, and not worry what will that do to my quarterly numbers in 3 months' time, 6 months' time, and what will be the impact on my share price. And again, something that many US companies cannot easily escape, but it's an interesting thing that are out there. And of course, privately held firms are also usually more successful than listed ones. Which companies have a better chance for future success in international business? I think the key word here is long-termism, if you want. We have to have a more long-term view going forward. Those companies that are alert to all of those competitive trends, which I described before, all of those players who are coming into the game in emerging markets, the customer, how it has changed, and how do we adjust our internal innovation and product development. Also those that take emerging markets seriously as they take the developed world. We still see at the strategic corporate level that many emerging markets are still treated in an opportunistic way. In other words, the CEO says to somebody called Dave, Dave, go to Dubai and develop business for us in the Middle East and North Africa and find some distributors and start shipping products. And then Dave, after a few years, comes back, and maybe even after 12 or 18 months, he says, there's a lot of stuff out there. Now I need you to give me some money to start putting some more people on the ground. We need to do some brand building, some market development, and so on. And the CEO turns around and says, if I give you now a few $100 million to do all of this, this is going to hurt our share price. And I'm very hesitant to do so. But again, I will elaborate on this point later on. Cash reserves, many multinationals are very well in this, doing very well on that side. And I think also we see a group of companies, and I would call them still a minority of companies, who are out there and they see emerging markets as a place where they can, during these, let's say, weaker economic times globally, increase the market share and outperform competition. The biggest thing that I will talk about in the next 20-25 minutes or so is how do you build a sustainable approach to emerging markets business? Because this has not been the feature for many companies. Even very sizable multinational firms are not very sustainable in their approach, not very systematic. And it's very opportunistic still, with not enough resources on the ground in many of these places. And that's something that has to change. And I mentioned also the last bullet point already. Now, let me start with a sort of series of slides related to how do you build sustainable emerging market business so that you outperform competition. One of the big points, and I wrote a paper for my clients about 4 or 5 years ago, which I think Bill has seen at the time, which was called the 2 mindsets for developing international business, distributed to all our multinational clients, etc., etc. But I see this as a really important issue for anybody who is looking now seriously, how do we take advantage of those growth markets out there. So the key item that I see out there is that every company of the future that wants to be serious in emerging economies has to be a little bit like that Steve Martin movie, The Man with Two Brains, where one side, or the two-headed monster, or call it the 2 mindsets, whatever you want to call it, but one side of the brain or one head is thinking the following: how do I protect my position that I have in these very large markets which are not growing fast, United States, Western Europe, Japan, etc., and how do I protect my profitability in those places? The other side of the brain and the other mindset, which requires a completely different mindset, is how do I invest for the long-term sustainable business development in emerging regions? And what do I need to, if I'm doing 100 at the moment, what do I need to do to go to 300 in 3 years' time? And what type of resources and where and so on. The reason, and I was thinking about some of the corporate examples for this, and you can see this in the very last bullet point here. We had a number of clients, for example, who were mixing recently, in the last few years, West European operations with Central and Eastern European operations. You know, just a corporate example. You see this also Latin America, North America as well. If you have a head of Central and Eastern Europe and Latin America, leave them to run the business in that part of the world. Do not have the same person also responsible for Germany, France, Italy, and Poland, Hungary, Czech, Slovakia. Or same person responsible for the US and the same person responsible for Latin America. That split has to take place because the person who is running also US or Germany, these markets are so big, so overwhelming, they're such large volume, you don't want anything to happen to that. You have no time and attention when somebody says, I have a problem in the Czech Republic and I want to invest some money in Kazakhstan. Or by the way, Peru now is a great opportunity, let's put some money in there. And you don't end up in the debates such as, should we hire 5 more people in Turkey or in Saudi Arabia or in the Netherlands or in the United States. So you see that separation taking place increasingly, and I will elaborate on all of this in a few minutes as well, in a bit more detail. But one of my big clients, by the way, had this Central Eastern European operation as a separate thing. Then they merged it into a pan-European structure together with West European markets. And guess what happened? The business started to decline. After a few months already, they lost huge amount of market share because nobody was paying any attention anymore, and they changed all the marketing as well and brand building. The same ads they used in Germany and France, they were now pushing on the Polish consumer. Complete disaster. One of the most successful companies in the world, by the way, globally, and also privately held, went in that direction. After 2 years of struggle, they separated again. And it's going it's working well these days. So it's important to keep that separation in mind. Think about Steve Martin. And going further into some of these things, to respond to all of this, so what do you do in terms of corporate structures? Many companies are now installing somebody called a head of emerging markets. So you have the CEO, and then there are two people, important people below. One is running the developed world, and one is running the emerging regions. And to the head of emerging markets, you have emerging Asia reporting into them, Middle East, North Africa, Sub-Saharan Africa, Latin America. Some companies would still keep a separate EMEA structure with all these sub-regions underneath. That's also fine, as long as there is enough focus on some of those areas. And the most important thing is that each market gets investment based on its own opportunity potential, rather than, the last point here is important. I have so many clients these days who are now going to the headquarters and saying, Saudi Arabia has this massive development program, hundreds of billions will be spent over the next few years. I need 15 people on the ground to chase that money. They go to the headquarters and they say, sorry, we are not hiring around the world, we have still a global freeze, you can't get it. And some companies are in that extreme still, and it's a real mistake and it's a shame. That separation of these functions, emerging regions and the developed world, really makes a difference at the end of the day. I think the guiding principle in all of this building of the sustainable business is all about how do we outperform competition over medium and long term. This is not about winning in the next quarter or 6 months or in 2011. And it's all about against competition, as it really is increasing these days exponentially. Many companies these days, and I work very closely with the company Nestle, the food giant, they have 10-year plans for every single country out there in the world for many of their business units these days. And many companies are now engaging in this long-range planning and saying, this is the vision that we have, how we want to do developing market business. This is what we're going to do in this and that place. This is how we will prioritize them. And this is how we will channel resources globally into some of those places. And I think the days of only 2 to 3 year forward planning is still solid and good, but I think there needs to be a long-range plan as well these days, because there's all of the reasons that I mentioned before. This sounds like a cliche, the next point, but considering the speed of competitive threats these days, the sense of urgency, speed, and agility is really important. To give you an example, and it's a really a good one, and Bill and I were in the same room when this happened. Dennis Jönsson, who is the Tetra Pak CEO, we were in Lund together in Sweden with some of his global directors back in October. And we were there the year before as well, in October. And Dennis, 2 years ago, when he spoke to his team, just before we engaged in our presentations and everything else, Dennis didn't speak much about competition. And he spoke about their business, where it was going, etc., etc. A few months ago, in Sweden, he spent most of the time speaking about, we have this Brazilian competitor, which is really very tough for us. We have this German medium-sized company. We have this Chinese competitor, which is copying everything we do. It was interesting how within a year, a shift happened from saying we are observing competition, to extreme focus on it, because it was just accelerating that quickly. And it was really destroying some of their market shares at an incredible speed during that time. And I think that just reinforces the view of that speed, urgency, agility that every company needs to have to be able to quickly respond to all of those things that are happening out there. The other thing which is important, I think it's also part of the long-termism in companies that needs to be embedded now. And that's the issue of sustaining the growth initiatives. I have too many clients these days still, even if they're very large companies, they go into this mode and say, we have this wonderful growth plan for Latin America. And we are going to grow for the next 3 years this much, blah, blah, blah. This is what we are trying to do. Then something happens in a market and or internally, and they say, let's postpone this growth plan for a few months, or for 3 months, or 6 months, and so on. And of course, it just opens a window for others to step in. And I think it's extremely important for these companies to sustain growth initiatives and not go into sort of sudden pullouts or postponement and so on. Once you start something, it needs to simply go through. The other thing is flexibility of structures as well. A good example, in the Middle East these days, you have huge difficulties dealing with governments in most places, as any of you who have done anything in that part of the world would know. It takes a huge amount of time. And yet, most of the multinational companies in our recent poll of them, they say we are having difficulties convincing the CEO to give us more people, or anybody at all, for government relations role, or external affairs role. And we as country managers and regional guys, we have to do this. We don't have time. And we are sitting on phenomenal profit growth and sales growth, and yet we're still unable. And because they say, well, you don't need it. For, our corporate rule says you get a government relations manager only if the corporate sales in that market are this and that. And we are still way below, so you cannot qualify for this type of arrangement. And go back. So I think flexibility of approach and saying this is what the market needs. And then we engage in bringing those people ultimately together, then in that makes sense. So flexible structures, flexible market approach, don't necessarily bring stuff, as Bill was saying earlier, that might work at home or in some of the other markets. Even emerging market from emerging market will be very different, of course. Then market share gains are something that really companies are prioritizing these days, and many KPIs and incentives are aligned along those lines. And that's something that you should also keep in mind. And still, interestingly enough, many companies out there try and do business sort of from a distance and say, we're not going to invest that much in understanding all of these markets. We just hire a distributor. He's going to find a way, and things will somehow turn right. But I think one of the biggest mistakes that companies have made over the last few years is not investing in this upfront understanding of the markets and market research and all of those things. So spend a couple of million if need be to understand properly where you're going. Building sustainable business further, a few more slides relating to what is really relevant is upfront investment and no expectations of quick return. I think that's really important. The other thing, which many of my clients wish their CEOs would be doing, to tell the Wall Street analysts to go to hell and not bug us with quarterly questions and things of that kind so that we can start running a business finally. As you know, some CEOs are trying to do this in a nice way and say, if you like our strategy, we will tell you in about a year what we did. And there's a growing number of listed companies in the US and in Europe who are refusing now to give any quarterly guidance to anybody because they know it's just destroying the emerging markets business. And so I think any company that can move away from this dependence or sort of quarterly calls with analysts where you have to give them some type of guidance on how much money you will make in 3 months' time, which is ultimately relevant, it's always good that you escape that. Other thing which happens very often is that the CEO says, you will get more resources to somebody who is a regional guy once you prove to me there is more business on the ground. And this is a very short-termist, suicidal catch-22. And no company that does this has ever developed a proper emerging markets business. It might be running for a few years okay, and there are some orders coming in, but at the end of the day, it always loses against competition. And I said the most important thing is how do you win against the competitive players out there who are coming from all directions. The next point is more about corporate arrogance, which we also see a lot, and that's slowly changing. But many companies, especially large players, they say, oh, of course, we are market leaders in the US and Western Europe. Of course, we will be market leaders in Turkey and South Africa and so on. And as we know, without upfront investment in brand building and everything else that you need to do to develop it properly, enough people on the ground, nothing really happens. One of the biggest points at the moment, which is changing extremely quickly, is moving the depth of local infrastructure on the ground. And companies that have had reasonable local presence are now increasing that and engaging in significantly larger local capabilities, local talent, local competencies, and more than anything else, also infrastructure in terms of having the right corporate structure which is localized. So moving from distributor-driven models to more localized to very, 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 very localized. And this is, in the next few years, this is how things will play out. These days, companies are having plans, and I've seen many of those in many meetings, how to become significantly more local than we already are. And this is going to make a difference. You can bet on this, that it always makes a difference in some of these places. At the same time, nobody is naive or foolish and say, we are going to have all our back office functions in every little market out there. So all of those back office functions, they don't need to be localized. Many companies are now still keeping shared service centers in regional centers, all your payroll and legal support and IT support, fulfillment, all of that stuff is still can be, and it should be, very much centralized so you save on the fixed costs. What must be local is sales, marketing, anything that's face-to-face. That's critical, and because, as you know, it's all about relationships in many of those places. The other thing which is happening, and will be happening more and more, is companies are increasingly decentralizing their approach to emerging market business. So they are putting more responsibility to the people on the ground. As soon as you appoint somebody to run a market, accountability, responsibility for results is yours. You don't, of course, make a decision on what the brand message is going to be. You don't make a decision whether you build a plant or not. But on the sales, marketing, on-the-ground implementation and local execution, this is what you need to do. Heineken, for example, one of my clients, they say there are 3 things that we will be doing in the next few years that will change our fortunes in emerging markets. Local execution, local execution, local execution. That's all they care about now. And this is where all the resources are being channeled. It's a very, very important point. And this is exactly along those lines of putting more people on the ground and giving them responsibility to figure out how to grow in those places. The other point, which maybe some companies still disagree with, and I'm sure there are many actually, but the strategies that actually work better, if you are working for a company that has multiple business units, different business units, a conglomerate, the results are always better if you have the regionally or geographically led structure. Give you an example. I cannot say the name of the company. Well, one large US multinational industrial player, 5 business units globally, major 5 business units. 2 of those very active in emerging markets, 3 not really. Why? Because the heads of those 3 units are not interested in emerging markets. They are simply quite okay with doing business in America, Western Europe. They have enough customers, enough business, etc. They're not interested. And these companies are leaving huge amounts of money out there on the floor, not picking it up. As soon as they changed the way they approach the business and say, this is the regional head for Africa, and regional head for Africa now goes to all the global heads of business units, and basically with the CEO, and says, you are now coming to Africa. You have not done anything here, but my team on the ground, the geographic team, has found these opportunities for you. And come here, bring the people on the ground, and we all will share the fixed costs across 5 different business units, and you will install people on the ground to chase the business. Huge change, as you can imagine. Once you put people on the ground for some of these business units, suddenly there is business found. If you're sitting back at home, usually nothing really happens. But geographically led structure always outperforms those that are purely business-driven, business unit-driven. At the same time, this is not the geography head now has total power. He still has in a matrix structure to work very closely with the heads of global business units, etc., etc. That's still important. Diversifying boards is important. Think of your own organizations, how many citizens of Turkey or China, India or Brazil you have on the board. And I think it's important for that board diversity to grow the business in emerging markets. Overall, it's extremely important. Avoiding toe dipping. Too many companies are still sort of testing the markets, running it only via a distributor on the ground, and really not getting anywhere. Just leaving a huge space for competition to come in, take the market, and it's very difficult. Once the market shares are carved out, as you know, it's quite hard to move them up again and to do anything about it. It takes a long, long time. Too many companies still are focusing just on brick, unfortunately. And there's so many good emerging markets out there, as I said earlier. The whole of Latin America is quite good except Venezuela. The whole of Asia is quite good except Vietnam, etc. So there are many, many great markets out there that many companies are just really doing from a distance, which is a shame. And I think we will see many, many localization efforts. These days, there is a temptation, of course, for companies to quickly pull out of Egypt. Mistake. You don't want to pull out of Egypt. Egypt will sort itself out and still keep selling. People still need to eat and buy stuff and so on. Of course, you're very careful about putting physical assets on the ground, but you don't pull out in a panic. And sustaining the growth strategies. That's a good prime example there. One of the big emerging markets out there over the next 10 years will be Egypt, regardless of who is running it. And there will be still business there. It's not going to go away or go to another planet. We spoke about competition. Don't ignore it. Don't rely on or insist on absolute certainty. It's often that we see at the headquarters levels in the US and in Western Europe that the boards and the CEOs say, but to make this decision, we still want this piece of information and you don't have it. So therefore, let's not do it. As we all know, anybody of you who has done anything in emerging markets, there is always something that's missing. And you can make a good guesstimate about certain things, but simply certain things don't exist. And you have to go with a gut feeling, and that's a really difficult thing for some companies to do. Fly in, fly out management. Running business only via distributors has also miserably failed. And this is why this localization effort is taking place more and more. We see companies today, and this is accelerating, supporting distributors on the ground more and more, in good times and bad. One of the largest food companies in the world from the United States is now actually acting as a bank for most of its distributors in some of the markets in Eastern Europe, in the Middle East, because they cannot walk into a bank and get a loan, or the loans are so expensive. So actually they are partly financing their own expansion by giving short-term loans to their own distributors and acting as a bank. And they're gaining market share. It's just an example of flexible structures that companies are implementing these days to try and make this work. And we spoke about product portfolio. You want to have it matched. But also, the last point here, do not underestimate the value of personal relationships. Somebody like Carolyn will know this, of course, coming from the market, which is not the United States. And I think we see a huge amount of increased understanding how relevant this is. In many places, in the Middle East, for example, friendship precedes business. They want to see you for 4 or 5 times and eat camel meat with you for some time until they get to know you. And then they will give you some business. Maybe they will want another 5 meetings. And then they start to trust you. And then things happen. So this is why fly in, fly out doesn't work. You have to be on the ground. And this is why local execution, local execution, local execution, to build those relationships, to build friendships, because that's where the business happens then. Companies are now increasingly avoiding expatriate managers. This is really a dying animal, increasingly. And if you ship somebody to develop some of these markets in those places, then put them on the ground at least for 5 years. Companies have this tendency to ship a star from America to run a business in Chile, or a star from Germany to run the business in Turkey. All these guys do sometimes is they maximize the profits so they can move on within a corporation within that 3 years. And that's not that difficult to do. You cut some promotional expense and so on. You kill the business for the long term to advance yourself. And we see so much of this. And you don't manage the relationships. You don't build any. You don't learn the language. And at least 5 to 7 years is a minimum if you do something along those lines. But increasingly, companies are relying purely on local talent to develop business, and I think this is going to be the trend for the next few years. Many companies still judging markets on headline news, media reports. I think what's important also, you must always, in all of these places, for the reasons that I mentioned, commodity prices, hot money outflows, you must have a plan B or C. It's hugely important overall, and warn the top management about anything that can go wrong, because you want to protect yourself as well, as I said. Political risk is another interesting point. You can ignore it safely I think, for any sales activities, and this is what most companies are doing it. When it comes to investment in physical assets, this is a different story. You have to treat it extremely seriously. But we have had major examples of many corporations doing business in war zones, selling because the distributor wants to buy, the local consumer has money, and sales are still going on. And you see this today also in places like Egypt and Tunisia, where there's a lot of turmoil, but sales are still ongoing, and the companies are not stopping the sales operations because of all that's happening. We will see continued moves into cheaper manufacturing locations, and there are many strategies linked to this, how companies are organizing their manufacturing these days, and very much trying to serve more market segments, and how do you manufacture. Sometimes it's even in the same factory, by the way, that people are organizing their manufacturing of premium end and middle of the pyramid product, and then they customize it in other locations. So all kinds of things happening these days along those lines. And of course, research and development increasingly is moving to emerging market locations. If you must have downward innovated product with stripped down functions and things that don't exist from your premium stuff, takes things away, those products usually are better developed in some of those poorer economies, because local researchers and R&D teams will be better suited to develop than maybe teams in France or in Germany. Improve your competitive intelligence. And then the last point I want to just spend 1 minute on, there are many companies that are now engaging in very creative financing of their emerging market expansion, because it costs a lot of money to localize, to do all of those things. One thing that's happening, by the way, which is really a growing trend, companies are locally, in addition to internationally, locally they're raising corporate bonds denominated in local currencies. So those debt obligation is actually matched by your future revenue currency as well. So you don't have the exchange rate risk. There are some companies that are listing on local stock exchanges. Nestle is now listed in Sri Lanka and Bangladesh and Nigeria. In Nigeria, they raised more than 200 million euros. And they are pouring 200 million into developing 150 million people Nigerian market. They didn't use any of their resources to do so. And more companies are doing this. And this is a nice way and quick way to develop and go really deep into some local markets, and then do acquisitions as well of some of the local players. Speaking about acquisitions, be careful about them. As you know, in emerging markets, they tend to fail because most companies fail to do proper due diligence. There are many things that can go wrong. And actually the success rate is something along 40% approximately. And not only due diligence, but also underestimating what you have to do with that company in the post-acquisition restructuring period. But if you have any questions on this, we can go through this during Q&A. Avoid joint ventures if you can. Usually they fail. I'd say 95% of them that I've seen over the years in emerging regions. Sometimes legally you have to do it, but if you can avoid them, avoid them. And building relationships with governments, and a few points on human resources. And we are now close to the end. Ignore global pay scales. People will come to you and say, I need to give my country manager in Russia now 18% salary increase, because that's the going market rate. And the CEO will say, sorry, we are only giving this year 3%, and that's it. And then people leave. I think adjusting to local supply and demand for white-collar workers is extremely important to reduce the turnover, to retain talent, to attract talent. And as we know, white-collar labor in emerging markets is very scarce. It's difficult to find, and still a major issue for companies. So it's important to employ even unorthodox measures to keep them on board. I have clients who are giving loans to their employees, who are buying some apartments for them as well, who are financing and giving them mortgages to buy their homes, because in some markets the mortgages are too expensive. They're giving them stock options at relatively low levels in the organization. It doesn't work maybe in the United States, but over there you want to keep them, you give them stuff that is a going market rate. You give them that BMW if they want it, and if this is the market rate. May not be applicable to some of the developed markets. A lot of companies will be innovating through local teams and local customers, and this is increasingly happening these days. And also investing in leadership training for emerging markets. I think I'm seeing now a tendency of companies to say it's not good enough anymore to have good managers to run these emerging market operations. We need great leaders, by the way. And I think also there's a huge investment in creativity training as well. And we serve together on the board of CCL, and many companies are shipping their people to CCL to do the great leaders training so that people are ready for that emerging market business and international business altogether. We will see over the next few years how companies are moving to a new level, the knowledge sharing between different regions. And they say, listen, we tried this new initiative in Philippines, and it's wonderful. It increased our market share by 18%. Everybody should know this in the company, and in Brazil it should be implemented immediately as well. And I think the knowledge management within companies is also changing extremely rapidly and will change further on. And as normal, of course, people will continue to improve their operational efficiency and supply chain, everything else that has to do with manufacturing to keep the costs down to do all of this. And I think this is just two more very quickly. I think we covered some of those. People are upskilling their sales staff in the emerging markets, changing marketing messages if need be, investing in brand building. And even if you have a problem convincing the CEO to give you some resources, then one good way is to say, I want to do some more business in Romania. I need at least one man and a dog office on the ground to manage the distributor. And if you do that at least, usually what happens is that business just zooms up because suddenly there are better relationships on the ground. And that really improves the business tremendously going forward. So one man and the dog works. And then, of course, it's just the first step. Visits from senior management in emerging markets have to be constant, and it's increasing. We see that understanding of the markets is increasing in companies. And don't just take your CEO to a 5-star hotel. Also take them because they will give you a budget of 45% growth if they only see the 5-star hotel. If they see the rest of the country, of course, then it's a bit of a balanced picture going forward. And just the last point here, the others are self-explanatory, but closing geographic and customer gaps is something that many companies are doing these days. And this is the way to go for the future as well. One thing on positioning, and the very last point, if you have a product which is maybe, I don't know, second tier in America, it's not seen as a premium, we see a lot of companies today positioning their second tier product in the United States as premium in Turkey or in Brazil and in Chile. That's the beauty of emerging markets business. You can do anything you like with the positioning in some of the places. And it's an opportunity to move a product which might not be such a great breadwinner for the company anymore into a completely new space which will be higher margin in some of those places. So there's a nice way to play with the positioning going forward. There are a few things here on working with distributors, but we can also get you these slides. I'll just leave you with this last point from the former CEO of Nestle, Peter Brabeck. If I want sustainable profits, I'm going to invest for the long term, even if it has a negative impact on the short term. For some of the members of the financial community whose time frame is between half a year and a year, it's very difficult to explain what it means to build up business in China or Russia, where you have to invest for 5 to 10 years before you get into sustainable profitability. And I think this is really the key word that I'd like to leave you with. Anything that you do in emerging markets has to be sustainable. So I'll stop here. Happy to take your questions later on. And I suppose turn to Caroline or Joe to tell us what's the next step. Many thanks for your attention. Thank you.